Hey everybody, welcome to this week's podcast. Let's get
Hello,
started.
hello. It's been quite a week. It's been quite a good week. We look at the markets. NVIDIA is doing great. NASDAQ's doing great. Even Bitcoin,
Mhm.
we saw a midweek pick up, and that's all data driven.
Yeah, every asset class has been on a strong recovery. QQQ is now hitting all-time highs again, which is great for risk
Hmm.
assets.
Yes.
We have been seeing pretty good inflation numbers. PBI was really good. I
Hmm.
think it was below actual expectations. So if you pull up the numbers, it was like was it 2.5 versus 3.3 or something? Uh,
For PPI,
yeah, for PPI.
PPI month over month was negative zero point 0.1, and the forecast was zero point 0.3.
Yeah, I'm just gonna look at the yearly because
Yeah,
I think that
yeah.
was
The
pretty.
yearly is more of important.
Yeah. Let's see what the yearly. Yeah, so the yearly was like 2.6.
Okay.
Yeah, so it was put 2.6, and the previous number was 3.1.
Yeah.
Really good numbers there. Inflation was, basically headline and meet expectations, nothing big there. But I think the biggest worry so far that has driven the market, especially the bond market and gold, has been the
Hmm.
employment data, right?
Yes.
So there's a downward revision of over 900,000 jobs over the last 12 months. Essentially, basically, they kind of overcounted 900,000 jobs, right?
That's a
People would,
scary number to overcome. That's a scary number.
yeah, it is. It is quite large. I haven't seen such a revision in a very long time. So, like, the numbers have scared the bond market, and we see TLT now going back in the bullish trend,
Hmm.
right?
And
So
TLT is like obviously going to go up when you have what rate cut expectations. Is that what TLT
yeah,
behaves like?
yeah, yeah. Essentially, what's happening here is the market is thinking the Fed is beginning to prioritize labor weakness over inflation. They
Hmm.
they are accepting the fact that inflation is around 2 to 3%, closer to 3% than 2, and they believe that the Fed is basically saying, hey, 3% is the new normal. Let's actually focus on growth and employment. And we kind of saw that with Jackson Hole. We talked about this a couple of weeks ago, but in Jackson Hole's transcript, it was clear that there was a sense of dovishness within the committee because they were more worried about employment than inflation. They believed that the tariffs was only going to cause a one-off increase in inflation, but the long-term risk was definitely job loss.
Hmm.
And I think that they were on the right track because we see the numbers coming out in terms of revisions, and it's clear that we have been overestimating the strength of the labor market.
Yeah, yeah. I think by far and large, I think we're seeing that in the result of obviously the bond prices going up, and I think what we're maybe expecting for next week's event, the next week biggest event being the Fed decision on Wednesday, is going to be is it going to be a 0.25 cut, a zero point 0.5 cut, or a 0 basis points cut? I think zero is at this point like what, 5% chance, maybe 10% chance. I
I
it,
don't think it's going to happen at all. I think
maybe even
25
lower,
bips
yeah.
is,
Yeah.
yeah. I
Yeah.
think I think at 25 bips is basically what's going to happen next week. The market has prepared for it, so if you don't do it, uh, it's going to be quite hawkish, and you're just going to hold and do nothing.
I think it's already kind of priced in too, right? Then people are
Yeah,
expecting that cut in. Otherwise, it's quite cooked. It's quite cooked.
yeah, it is right, and there's been even like so much fear mongering that there's a 6 to 10% probability of a 50 bips cut. So is that going to happen? Probably not. And
Hmm.
I would be willing to put money in saying that it's probably not, right?
Hmm.
But they're going to cut. It's just how much and how far. The markets currently has priced, two cuts in for this year. So there's one in September, and I think there's another one in December.
Hmm.
And the biggest event though will be the forward guidance and what they expect to happen next year. I think that the 2 cuts is set in stone for this for the next 4 months, but it would be important for us to know how dovish they'll be next year and how far they're willing to cut then. We're starting to see gold becoming, overbought as if it's not already.
Yeah, it's been quite overbought for quite a long time.
Exactly, right. But this time around, though, it seems to be following bonds as well. Over the last couple months, over the last year, we saw there was some sort of inversion with gold and bond, where gold goes up and bond keeps getting sold. Now bonds are now becoming more bullish along with gold, and I think we're returning to a bit of more conventional trading where the risk-off assets are actually performing like they're risk-off assets. Over the last 9 months with the Trump administration, it sounded like touching bonds was just a one-way street to losing money.
It did feel like it for a very long time.
And honestly felt like you were basically buying equities with bond returns. With the fact that TLT is going back to bullish trend, I feel much more relieved that the markets have a greater trust in U.S. debt now. So is the U.S. debt under control? Absolutely not. But
didn't the Feds buy back another 10 billion of their own bonds back temporarily or something? I remember this headline going around. So
I would have to verify that. I'm not so sure. But looking at the markets, I don't think anyone cares because you keep like all-time highs.
But I think we're at a fake high. We're not we're like high for what reason? Obviously there is the standard uptick, right? In a year, you're expecting the markets to be up 10-15% just based on the fact that the economy it's continuing. That's how the engine works. Now, but why is it up this week? I can think of 2 catalyst events. One event was all about PPI being way nicer than what we maybe were fearing from last month's PPI report. And so that was number one of like, hey, things maybe aren't as bad as they seem right now in the immediate future. And then number 2 has been about Oracle. Let's talk about Oracle, because Oracle is the strange beast. Oracle is really into data centers, and I was just looking at it, it's so funny. It was like the overshooting of the next day from the anchor. Wow, look at that! Look at that scary difference. And so we have Oracle, who's just doing fine. Oracle's always been a tech giant, and we see a nice earnings miss for Oracle. It's like a 0.75% surprise. Like a small miss. And so it's not too bad. But the next day we see a 40-50% jump in its price. What was all that about?
While it did miss, I think what really caused the rally on Oracle is the forward guidance and how much demand that Oracle actually experienced during the last quarter, right? So I would have to search up the exact reasons, but Oracle seems to be leading in the rollout of AI, and this is especially connected towards cloud computing, and how why the market thought that the AI bubble has popped. Looking at Palantir and NVIDIA so far, Oracle basically said, "Hey, there's actually more demand than you think." And the market's rushed in because it wasn't just Oracle getting bid up to 30-40%, but NVIDIA, AMD also rode Oracle's coattails.
Yeah, I mean, but the funniest thing to me, right, is this is all from again a contract of spending into AI infrastructure, and we just see that, and then we go right back to all-time highs. It's just it's funny, we just talk we see the AI bubble struggle. We see like AI stocks maybe diminish. We meet some fears of what the value is going to give, and then we see more spending. We see bigger contracts, and we have euphoria again. Now
Yeah.
I don't think I'm a doomer. I don't think I want to go down that route of being a constant doomer and say, hey, things are always overbought, blah 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 blah. But I just feel
Mhm.
like the current market highs, they're kind of flimsy. Obviously they're driven by three events: the PPI, the upcoming Fed decision, and well, this one-off event of Oracle. I just
Yeah.
feel a little bit uncertain. But I am very glad the market is moving up.
Me too. I think that looking at anchor system, QQ is definitely overbought now. We are approaching levels where I would either buy puts and short this thing,
Mm-hmm.
or just sell off and stay in cash.
Mm-hmm.
Same thing for, I think, Bitcoin. I'm looking at Bitcoin right now. It's starting to get close to our overbought zones.
Yeah.
So there's a lot of tickers that are now, you know, getting overbought. So short-term wise, I think it's a great place for us to take some profits off the table if you were able to buy those dips recently,
Mm-hmm.
and just be patient. Who knows? Maybe now it's time for us to pivot into risk off, like TLT or something. Especially now we're in mid-September. But right now, though, I don't think there's any reason to actually buy risk off. Equities are still the way to go. There hasn't been any big, nasty event that's happened. Yes, the revisions were pretty bad, but we still have strong GDP growth, right? So, based on the market sentiment, based on the productivity so far, productivity data has been very strong, and I think that's mainly due to AI. The economy is now more reliant on technological advancement than pure labor participation.
Yeah, it's not necessarily a good thing, but it's a good thing for now.
Yeah, exactly, right? Like, I would argue that because the economy and the growth from all of this is more based on technological progress and AI, you're seeing more of a jobless recovery, because a lot of that growth is going into these companies and it's not being distributed through higher employment numbers. Because if
Mm-hmm.
you're talking about inclusive growth, you'd be saying, hey, more people are participating in the labor force. If there's strong GDP growth, that growth can trickle down. But we're not really seeing that trickle down because, again, there's not a lot of jobs being created. So with less bodies being involved in the economy, and with the same strong number of growth, I worry that over a long run, this can cause aspects of wealth inequality that's already quite present in the U.S. economy.
Yeah, yeah. It's the problem that we have to deal with at some point in the future. But at this point, the ambiguity is when and if at this point, right? Um,
Yes.
but I hopefully it's not something that you know takes place in the market short term. Given that nearly all of my assets are deployed, I'd be really hurt if something big happened. But I don't think anything will happen in short term. And
Yeah.
for the market sense. One thing I do want to
Yeah.
talk about actually is looking at Bitcoin. Usually we have our predictions. Like our model makes a short-term prediction, and then when Bitcoin start tapering from its high, it reached the high of 123, 124 on
Yeah.
August 14th, and August 15th we saw our model make a first negative prediction,
Yeah.
and then, well, from that prediction, it it called, it made a right call on the slide,
Yeah.
and that slide lasted all the way through September 9th, with September
Yeah.
10th being the first positive day. So Bitcoin has shifted into a positive prediction environment. So I am quite optimistic on Bitcoin, but I think next week is going to be heavily centered around the one event of Fed rates. We know we talked about what our expectations are, but I think we should talk about what we think will happen based on what Fed decisions are made.
Yeah. So I think markets are pricing in a dovish Fed and a Fed that is more worried about job numbers than inflation. So they're hoping to get that in the meeting. But if we hear language like, oh, we want to be even more data dependent, we're not sure of tariffs are creating uncertainty, we lean towards a direction of caution on inflation, I think that will spook the markets. That would spook me, actually, personally speaking. That would spook me if I did that, because then we are repricing some expectations in the future. And if, let's say you do the opposite, they say the market deserves to be worried about the employment numbers. Oh, we're very worried about growth, right? We haven't seen any strong examples of that yet in terms of how it's affecting growth. But if we see that language, I think markets would be euphoric because GDP growth is already pretty strong.
Yes.
And for the Fed to cut even more on this, they're becoming extremely accommodative, and they're no longer just being neutral on the rates, right? Because for new listeners, there's something called a neutral rate for the US economy. So that rate is basically the interest rate that doesn't impede growth, but it also doesn't stimulate growth. And because of the higher inflation we had over the last couple of years since COVID, they believe that the neutral rate is now somewhere between 3 to 4%, closer to 3% than 4%, but it used to be around 1 to 2% in the past in terms of interest rates. They think that if the Fed were to cut into this as it goes closer to 3%, the market is going to be extremely loose, and the Fed is going to become very accommodative, allowing a lot of liquidity, allowing a lot of risk taking to happen. And we would probably see God candles on Bitcoin and any risk asset if the FOMC committee becomes very very dovish on that meeting. I doubt it. I doubt that's what's going to happen, because they're usually not that.
No, they're not that loose, not at all.
Yeah, they're usually not that irresponsible, because they know what they say can move trillions. So currently, as it stands, I think they'll still use that very neutral language. They're gonna cut. But they're not gonna cut that much. Nor are they gonna be guiding so accommodatively over the next 12 to 16 months. But let's actually move away from this and talk about Canada's economy so far. So so Canada, as we touched on in the last couple of weeks, has not been doing so good, and there's, I think, a rate cut happening this coming month.
Yeah, same day actually.
Yeah. So what are your thoughts about the Canadian economy so far? We don't really talk about it, but I think it'd be interesting we kind of bring it up.
Yeah, I mean, the Canadian economy is really, really struggling, especially after being hit with the tariffs. I would need to get my facts straight on this, but I think the Canadian GDP has suffered for this quarter. Maybe I can look that up myself somewhere over here. And the GDP. Maybe I'm wrong. Oh, the data's not up to date, so we don't know yet. I think the Canadian GDP has struggled in the last quarter, and I think it's actually heavily impacted by what is happening with the tariffs. And I think employment has been all-time low. We have been in a hiring freeze for what feels like close to a year. Maybe a bit exaggerated, definitely like 8 to 9 months of a hiring freeze, where we're seeing more and more unemployment, fewer and fewer job opportunities. There was an unemployment data that came out not too long ago, and honestly, it was not as bad as it seemed, despite being, I think, 6-7% unemployment. And that was all because there exist part-time jobs that people are forced to do, and these part-time jobs are propping up the unemployment data numbers. So things are not as very, very good here in Canada. On the plus side, the housing prices is going down, so that's good for the younger crowd who maybe are in a good place to invest in real estate to buy buy themselves a place. But for the economy as a whole, very very bad spot. I think rate cut here definitely makes sense. I mean, I think it kind of needs to happen. If it doesn't, I really fear that we're just gonna go more and more into a recessive mode of just saving what we can, knowing that everything is tough. Prices for consumer goods are going up. Sales are going down because a lot of our customer base, a lot of our local businesses, not local, a lot of our businesses are businesses that send products across the border. And so a lot of the businesses are heavily affected, and they're just having to price in the impacts now, and they'll feel the impact over the next year. So yeah, we're definitely not in a good place. And so I'm really expecting a rate cut here for Canada as well.
Yeah, that's a pretty accurate assessment of the Canadian economy right now. And I think just going a little bit deeper, the reason why this is the case is because real estate has been such a huge component of our economy, and it's been sucking up all the capital that we could deploy into technological advancements, research, and just business investments.
Mm-hmm.
A lot of Canadians, tend to invest in real estate. They've been groomed into thinking that like real estate is the best vehicle of holding capital, and that's what everyone has done. The problem is when you prop it up that high, well, you're creating a bubble in the real estate market, and you're creating a rentier economy where all the young people are just forced to barely afford rent and food, right? And the basic necessities. So even if the housing prices continue to go down the way it is, it needs to go down even more. And yes, you'd say it would help the young adults who are struggling to afford rent and find housing, but you would also be impacting older demographics that already own homes. So I think Canada's in a tough bind because if you cut interest rates, you're propping up asset prices like real estate, which would just compound the problem that you're making it harder for young people to get by.
I mean, I think,
but if you don't,
I think that like this year, just in the quarter by quarter, even last year, Canada saw the highest number of immigration it has in since like 1960s. So
yeah,
it's, I mean, there's lots of problems here. There's quite a bit of systemic problems at this point, right? Because as you say, there's so much money that's invested into the market, and the worst part is there's so much foreign money invested in the Canadian housing market, and so it's just very hard to combat what that has done to the system.
Yeah, I agree on that. Yeah, and
the biggest worry is I think the labor force. I think that should be the biggest worry. 7.1% unemployment is quite frankly unheard of. And like for an economy that's supposedly growing, with the U.S., 7.1% is what you see when we're moving towards a recessionary economy. Was it? I think the unemployment was gonna be that high only during COVID, right? When COVID first hit. But I mean, at that point, there was also lots of government support. Actually, no.
There was.
Yeah, in the COVID during it was just less high.
Yeah.
But
there was a lot of government support, but we don't have that support now because when we did that last time, it caused huge spikes in inflation, right?
Yeah.
Now it's more like, okay, we see people struggling, but you can't print money and give it away because that would just make the problem worse. We've seen cost of living shoot up because of that, and I think that the rate cuts won't actually make a lot of benefits for the average struggling Canadian, because rate cuts, it really only just props up asset prices.
Yeah.
And causes the people who hold assets to spend more. Well, if you're doing that and most people don't have assets, that are liquid, such as stocks or any other equities, well, what ends up happening is that you're driving the wealth of inequality and you're making it worse, because real estate, which is a very highly illiquid asset, will continue getting propped up, and the root problems in Canada's economy, which is expensive housing, won't be addressed.
Yeah. Yeah.
So we are stuck in a bind. I think the other administrations we've had so far have tried to help Canada's economy with massive amount of immigration, but we've been experiencing backlash on that policy because there's just too many people coming in and there's not a lot of jobs to go around. Just looking at the unemployment rate, you know that people don't appreciate immigration right now. This is the worst time to do that.
Yeah.
So, just we rarely talk about Canada this extensively, but I do feel that because both of us live in Canada, it deserves a topic in this podcast, because especially that there's a rate cut announcement happening next week.
Canada has more. I mean, US also had its own fair share of systematic problems, but I think Canada is facing the impacts of them in the immediate future, and it's going to be quite a tough few months to navigate. See what really happens. I just hope there's support for the labor market, because that's where people are struggling. It's I don't know. At this point, maybe even a sacrifice to growth would be okay to see the labor market not struggle as much. But I don't know. Maybe that's the wrong idea. Maybe that's quite a bit point of debate. I mean, the idea always has been you prop up growth so that businesses can feel open to create jobs and take more people, so that they are training talents, and they're bringing in, they're willing to raise talents. Right now, people, a lot of unemployment happens. A lot of unemployment is happening not for the older working class. It's happening for the younger working class. People who are less experienced, people who maybe are coming fresh out of the university, people who are just few years into their career, and so then you're having to compete for the same job against seniors who maybe were unemployed because of some structural reason. And so obviously any sensible business would take the senior person. And so unless the Canada's economy is in a state where the businesses feel like it's okay to spend some money to train people, to make even cultivate talent, until we're there, it's going to be quite a bit of a scary environment, unless the government can do something to incentivize or to guide labor further. So we'll see what happens.
Yeah, and I think we can call it a wrap here.
Yeah, let's call it a wrap here. Scary times, but good for the U.S. economy, though.
Yeah. So thank you everybody for tuning in, and we will see you next week. Please don't forget to subscribe.
Awesome. Thank you.